Welcome. I think we're going to have a few people coming in late, but we want to get to the cocktail hour at exactly 6 o'clock because attention spans do have limits, even though what we find interesting is going to be buried in the next hour and a half or so. So I think this is going to be a useful program. I'm John Van Gorp, and I co-head our structured finance group at Mayer Brown. I've got several of my partners here that I will introduce in a minute, but there's also several other structured finance partners and colleagues in the audience today, and we're delighted to welcome you to our firm to cover what has been a tradition for us to talk about what to expect in the next year. Now, there's nothing here that's going to make you a success in Las Vegas by what we're going to say. There's nothing here that's necessarily going to come true because we say it. But we do think that in the past we've got a pretty good record of analyzing the regulatory changes and giving people insights on how the market is adapting to them. And that's the intent today, is to give you a real practical knowledge of what we're working with in terms of regulations that are in the front of our minds right now and how they're going to affect the business that you all do over the next year. Just a few administrative notes. For lawyers in the audience, CLE credit will be provided. You need to fill out some paperwork that's outside the room in order to qualify, but that is going to be provided. The program is being recorded, so if you have colleagues back at the office that think that this must have been the most exciting thing of the year, you can replay for them over the web, and that'll be available, I think, tomorrow. At the end of the presentation, we'll have a little bit of Q&A. And I'll moderate that, and so please hold your questions until the end. Also, please hold your applause until the end. As I said, we'll have a cocktail reception immediately following, and that is our goal of getting wrapped up by 6 o'clock. So let me briefly introduce the partners who are going to speak today, and I'm going to start down at the end and work my way over towards my podium. Julie Gillespie is a partner in our structured finance practice. She's known as our credit card expert, but she does a lot of things, and she in particular has been involved in representing the trade group SFIG that we all know about on their credit risk retention project. So she's going to cover credit risk retention today. Carol Hitzelberger is sitting to Julie's left. Carol is well known to many people. She's one of the most senior partners in our securitization group, and in particular has a bank regulatory and accounting expertise that you'll hear about later today. Wonderful creative structurer. Next to next to Carol is Stu Litwin, who is a co-head with me of our structured finance group. I wrote some notes here about Stu. It's hard to describe him in a sentence, so I said known as an expert on almost everything in securitization. He has been involved in almost everything we've done over the years, and some of the things Stu's covering today I think you'll find particularly interesting. Jeff Taft is sitting next to Stu. He is the only person who's not in our structured finance group, although he's an honorary member. He is a financial services and regulatory lawyer focusing on consumer finance, and that's been in the news recently and a hot issue, and Jeff's going to have some interesting things to say about what you've been reading about in the newspapers. Finally, Angela Ullum is a structured finance partner who has spent a lot of her time working in the auto finance field with issuers, borrowers, investment banks, a variety of other parties in those transactions, and has been at the forefront of some of the new developments in auto finance as they're impacted by the new rules like Reg AB 2.0. So with that, I'm going to turn over to Stu to talk about Rule 2A7 and the revisions and how they are impacting asset-backed market when they come online this year.
Thank you, John. I'll pretend to Stu today.
Oh, sorry, it's Carol. I apologize for that.
I think that's Carol talk about something.
I'm going to talk about 2A7 rules. You all may have heard us, I'm sure you heard us talk about this a couple of years ago when these amendments were initially adopted, but somehow they've snuck up on us and they're actually going to become effective this April. And so I know that a lot of clients are asking us about how the changes are going to impact their securitization transactions. 287, of course, are rules that govern the activities of any fund that wants to call itself a money market fund. And money market funds, of course, are prime investors in ABCP as well as other short-term ABS products that are being issued by lots of our issuers. The issuer diversification rules for 287 funds require that any fund not have more than 5% of its total assets invested in the securities of a single issuer. That's the current rule. It's important to note that the issuer diversification rules don't apply to securities that are fully guaranteed by a non-controlled person, however. Okay. We're a couple slides ahead up there, so I'll just... Who's covering the slide? Is that you?
I am. I've got it under control now.
John. Okay, what's the impact of the amendments that take effect in April on the issuer diversification requirements? Well, a money market fund now is going to have to treat as a single issuer for purposes of the 5% rule any two or more issuers that are affiliates of one another as determined by voting control. So 50% voting security ownership will constitute voting control, and you'll then need to aggregate those issuers together. That's called the affiliate rule. This has obvious impacts on securitization, especially in the United States, where the typical securitization structure is for the SPE issuer to be owned by the originator. So you may have one originator, say Ford, to use Stu's example, and it has many SPEs that are all owned by Ford. Well, now, starting in April, money market fund investors that want to invest in those issuers' securities will have to aggregate all of the securities from the affiliated issuers in order to determine whether they're in compliance with their 5% issuer diversification requirement. There is an exception, fortunately, for owners of commercial paper conduits, and it's only for commercial paper conduits. As many people know, commercial paper conduits are typically owned by special purpose entities themselves, which are set up for the sole purpose of owning these types of conduits. Those entities are excluded from the aggregation rule. So, for example, global securitization or Lord Securities, etc., you wouldn't need to aggregate all of the CP vehicles in the world because of their ownership together. The 10% obligor or look-through rule, this is something that applies really just to commercial paper conduits, but the general rule of thumb is that for primary ABS, which would be the ABCP itself, any person whose obligations constitute 10% or more of the obligations that support that primary ABS are deemed to be an issuer to the extent of their allocable share. That's a rule that's in place now. There's no change. It's something that ABCP issuers are used to dealing with, but to flip through the next page, the affiliate rule that I described earlier will also apply to the 10% obligor look-through. So the practical implications of that are that conduits will need to aggregate the SPEs that have common ownership of their customer SPEs together for purposes of determining whether or not they have a 10% obligor that they need to disclose to their investors. And certainly 287 investors will be looking for that. There's always been an exception for what's called restricted SPEs or RSPEs. A restricted SPE is an SPE that issues ABS only to the conduit itself and not to any other party. So as a practical matter, there's no way that the 287 investor could get exposure to that SPE other than through the CP conduit that it's funding itself through. That, fortunately, has been retained notwithstanding the amendments. So restricted SPEs can continue to be used, but there's still an impact on them as a practical matter because they will be included for purposes of determining whether or not there is a 10% obligor disclosure after giving effect to aggregation. So I'll give you a quick example and then we'll be done with this because I know we're running out of time for my piece. If you have an RSPE and an SPE that both have a common owner and both are being funded by a commercial paper conduit, let's take an example where the RSPE constitutes 14% of the conduit's assets and the other SPE constitutes 0. It's unfunded. At that point, there's no disclosure. Even though you have a 14% RSPE, there's no disclosure because it's only the RSPE. Added, yes, nodding his head because we've gone through this. If you have an RSPE that has 5% of the conduit's assets and another SPE that's not an RSPE with 4%, again, no disclosure because you combine the two and you're at 9%. If you have an RSPE with 14% and an SPE that's not an RSPE with 2%, you're now going to have disclosure because the 14% plus the 2 is 16, which is in excess of 10. You've got to disclose, you've got an excess concentration, so to speak. So you've got a 10% disclosure, but it's only the SPE that needs to be disclosed that's not the RSPE. You can do the same thing vice versa with the RSPE being 2 and the SPE being 9, and you still have the same issue. You're going to disclose the obligor that was the one that puts you over that's not the RSPE. The last point here really on this slide, because the rest of it is just a repeat of what I've already said, is the amendment also includes another complicating factor for sponsors of all ABS, which clearly is going to pick up sponsors of CP vehicles, but can pick up other sponsors of ABS as well. And that is a sponsor of asset-backed securities will now be treated as a guarantor with respect to the entire principal amount of the ABS, even if the sponsor is not providing any express support for the ABS. So unless the money market fund's board of directors makes an express determination that they're not relying on the sponsor, which it's difficult to imagine that being the case for commercial paper conduits, but certainly a possibility for others. So the net result of that is that, say, in a commercial paper context, the money market fund investors will have to look at two limits. One would be the CP issuer as a 5% limit, and any of its affiliates, which should be none. And two will be the bank, who's the sponsor of the CP vehicle, as a guarantor limit of 10% when you aggregate it with all other securities that are issued or guaranteed by that guarantor. That takes us to the end.
Okay, great. Thank you, Carol. Julie, I'm going to get it right this time. You're going to kick off risk retention, and I'll bring up the rear on this topic. So if you could start, and I've got our slides teed up here.
As I'm sure this audience knows, the U.S. risk retention rules took effect for RMBS transactions at the end of December of last year, and will take effect for all other asset classes on December 24th of this year. And rather than summarize the provisions of the rule, I thought I would just take the time I have to highlight a couple of points that are being discussed in the market right now. So first, I think it's worth keeping in mind that the risk retention rules only apply to asset-backed securities as that's defined in the Exchange Act. So for purely private deals, for example, warehouse facilities, there may be some benefit to intentionally structuring those deals to be loans rather than issuances of securities, and something that I think a lot of sponsors will want to keep in mind as the compliance date gets closer. Second, sponsors and other market participants are just beginning to think seriously about what type of comfort they will need or want from their lawyers and accountants, and lawyers and accountants are really starting to think seriously about whether they're going to be able to deliver the type of comfort that's being asked for in terms of whether transactions comply with the risk retention rules. In many cases, compliance with the rules require a sponsor to make a number of accounting determinations. The most obvious example being that when you're using a horizontal method of risk retention, the sponsor needs to determine whether they're holding 5% of the fair value of the ABS interest in the transaction. We're also seeing accounting questions arise in transactions where sponsors form majority-owned affiliates to hold the required risk retention. In those transactions, whether the structure works for risk retention purposes turns on whether the sponsor has a controlling financial interest in the affiliate for purposes of GAAP. So accountants are still considering what type of comfort they're able to give on fair value and controlling interest in the other accounting questions related to risk retention, and whether they're going to be able to deliver, and which parties in a transaction would be able to get any type of reports they might issue. Similarly, market participants are beginning to ask lawyers whether they're able to deliver legal opinions as to whether a transaction complies with risk retention. And the American Bar Association has formed a joint task force of the Structured Finance Committee and the Opinion Committee, and we expect that soon you'll be seeing an article come out from that committee with some preliminary conclusions as to whether they think legal opinions on that topic would be appropriate, and hopefully not to give too much of a spoiler alert if I preview the conclusions of that committee, which is that they do not feel that legal opinions on risk retention would be appropriate. Of course, those committee discussions are still ongoing, but the preliminary view is based on a number of factors, but particularly the fact that for U.S. risk retention, the burden of compliance lies with the sponsor, and the risks of noncompliance would fall on the sponsor. And there's been a great deal of discussion contrasting U.S. risk retention with European risk retention, where there is a practice to deliver opinions for the benefit of investors and investment banks. Of course, this market practice is still very much developing, and there are already requests being made for legal opinions in RMBS transactions. So where the market goes on this really remains to be seen. Lastly, I wanted to highlight potential ambiguity in the risk retention rules relating to variable funding transactions. So a typical warehouse facility where an investor has a maximum commitment, but the balance of the securities fluctuates up and down. Under the risk retention rules, the percentage of risk retention required to be retained is required to be determined as of the closing date of the securitization transaction. So the interesting question for a variable funding deal is, what is the closing date? Is it the date you issue the security with the commitment, or is it the date you fund under the security, or each date on which you fund? And in December of last year, the SPES Risk Retention Guide Working Group published an interim draft of their guide offering interpretive advice on a number of subjects, and the guide did attempt to tackle this question. So absent any guidance we might get from the regulators in the future, the guide recommended that for variable funding transactions, sponsors treat each increase in the balance of a security as a separate closing date on which you would determine risk retention. So I think the next natural question anyone asks is, so what do you do about transactions issued before the compliance date if you fund after the compliance date? Are fundings after the compliance date subject to risk retention? And does this mean I need to amend my warehouse before the end of the year if I want to continue to do new draws under the facility? Well, at least the SPES working group in December wasn't willing to tackle that harder question. So I think it's going to be a subject of ongoing discussions with sponsors and their law firms over the next couple of months. So I will turn the floor over to John, who's going to talk about his recent experience with risk retention in RMBS.
Okay, and I'll be really quick here. And just a reminder, RMBS deals had to comply as of Christmas Eve last year. Everybody else gets to wait until Christmas Eve this year. So Christmas came early for RMBS deals. And we had some deals done last month, and it was pretty smooth. I will tell you that, as Julie predicted, eligible vertical interest was what people elected in terms of the risk retention format because of the accounting and disclosure concerns about the horizontal interest. And I think we'll continue to see that. There's been a healthy market to repo vertical interest, so people who've retained those have found financing. Financing has to be done on a full recourse basis basis. There's lots of interesting issues that we won't get into here about what constitutes a full recourse financing that have been sorted out. There were some issues for funds in terms of how they could retain risk if the decisions were being made by historically a fund manager. There's been some solutions that have been developed there, so those issues seem to be sorted out. In terms of opinions, what Julie predicted is happening. Risk retention is getting carved out of legal opinions, and there seems to be good consensus on what is scoped out of the rule. For example, single-family rental transactions were viewed as not mortgage-backed transactions, but something else that's subject to risk retention this year, not last year. So in all, a pretty smooth process, I think, in implementing the rule, and I think a good predictor for what will happen at the end of this year when the other assets come online. Okay, on to Jeff Taft to talk about 3 interesting cases and other developments in the marketplace lending area.
Thanks, John. As John indicated, I'm going to talk about 3 cases, but before I get to the cases, I want to lay a little bit of the groundwork for those who don't necessarily travel in this space frequently. These cases all revolve around what we call the traditional bank origination model, or they cast some doubts around the traditional bank origination model. That to most people means rent a charter, rent a bank. We'll call it the traditional bank origination model amongst ourselves here today. Under federal law, banks can basically export interest rates. That means they can charge the rates and fees permitted by their home state to borrowers who are located in other states. Because of that, retailers, marketplace lenders, and others have often partnered up with banks to issue credit, and then the retailer would basically buy that credit back from the bank. Under the traditional structure, you basically have the bank originates the loan, holds it for a couple of days. Usually the terms, the underwriting of that loan is based upon terms that the bank and the partner agree upon, and they're adopted by the bank. The bank sells the loan to the retailer or to some third party designated by the retailer after 2 or 3 days. And basically the purchaser bears all the credit risk on that. There's really no risk that remains with typically with the bank. The partner entity who buys the loan typically is also the one who services it. One of the concerns that's historically arisen in these traditional bank origination models is that somebody other than the bank could be considered the true creditor, i.e. the purchaser of the loan could be viewed as the true creditor. And if that's the case, then the loan is likely usurious under state law because that purchaser of the loan didn't have the interest rate authority to charge that interest rate, and they don't have a license to charge or to serve as a creditor, basically. There's been some challenges to that model over the years. The 8th Circuit in the Crispin case is one of the leading cases where they upheld that model and concluded that the bank was in fact the true creditor. The bank who retained the account relationship because it was a revolving account was the creditor and not the bank's affiliate, the retailer who was actually buying the receivables 2 days afterwards. Closed-end credit has historically presented a little bit more of a challenge because you don't have the same fact pattern. In a closed-end arrangement, typically the whole loan is being sold to the purchaser. The bank doesn't really retain any sort of customer relationship. So you don't have that to hang your hat on, what you had in Crispin and what you had in some of these other cases. The case law has kind of gone back and forth, although most of it is favored the bank being the true creditor. There's a case, CashCall case in West Virginia, the Morrissey case, that goes the other way, and that's probably the most recent significant case that's held that the purchaser is in fact the true creditor. That had some bad facts involved. I guess any case that has CashCall has bad facts involved because they're making loans at 200 to 300% interest. Not very sympathetic to most jurors and certainly a target for most AGs. Let me talk about the Madden case first, because that's the one I think that's on everybody's mind, and that's been out there since last summer. Madden really wasn't a true creditor case. It's a little bit different. Madden involved charged-off credit card receivables that were sold to a debt collector. The debt collector tried to collect those receivables and continue collecting interest at the contract rate, which was 27 or 28%, above the New York's usury rate, which has a criminal usury rate of 25%. The defendant in the case, or the person whose account it was, brought a claim in New York District Court basically challenging the authority of the debt collector to charge interest on that receivable. The district court said, no, of course they have the ability, it's in the contract, the bank had this contract, this is all part and parcel of the same agreement, the debt collector can collect on this. Case got appealed up to the Second Circuit, nobody really expected much to happen except for them to affirm. lo and behold, the Second Circuit did not affirm the case. They basically said, no, we don't think that the debt collector has the ability to collect at the interest rate that the bank was charging. We don't think that the bank's federal preemption or its exportation rights permits the debt collector in this case to collect. The bank has no continuing relationship in this arrangement. Therefore, the debt collector can't rely on federal preemption. It caused a lot of us in the industry to kind of shake our heads, but the ramifications obviously are significant, not only for the particular facts in Madden, but also it goes beyond Madden. There are other fact patterns that this would clearly apply to. And marketplace lending has been the one that everybody's been focusing on, but really any kind of closed-end loans. So that's the Madden case. And the Madden case right now is kind of pending whether the Supreme Court will take grant cert in the case. It's probably unlikely. The Supreme Court grants cert in very few cases, so it may very well be that this case will remain as it is for the time being. Think Finance is a case from January that basically follows along on Madden. It's a Pennsylvania Eastern District case. It's really only on a motion to dismiss, so I don't think there's really too much you can take away from it, but it's certainly a case you want to watch. It basically was a rent-a-bank, rent-a-tribe arrangement. They were using both forms of the traditional lending model. And basically the Pennsylvania District Court dismissed the motion to dismiss from Think Finance, who was trying to get the case kicked, saying that they had the authority under federal law to basically, to export, to charge these interest rates that the loans were being charged at. Think Finance is like Madden, and it cites to Madden, but it also presents a true creditor issue, because involved in this situation is an allegation by the Pennsylvania Attorney General that Think Finance, in fact, was the true creditor, not the bank that had originated. So as this case moves forward and these kind of lines of thought get more developed, it's going to bear some watching. They gave an initial preemption analysis under the Third Circuit law, which quite frankly isn't very favorable and is very similar to the analysis that the Second Circuit had in Madden. The third case I want to talk about is also a cash call case. This case doesn't involve cash call lending. It involves them acting as a broker. The Maryland Department of Financial Institutions brought an action against CashCall, saying they were basically an unlicensed broker. So in other words, they said that CashCall might not have been the true lender, but even if they weren't, they were basically engaged in a brokerage activity because they were bringing borrowers to the lender and they were being compensated by the lender for this service. The Maryland Department brought a $5.6 million action against them. CashCall appealed that case to the court in Maryland. The Maryland court initially sided with CashCall, but the special appellate court reversed that case, and now the case is being heard again on appeal by another Maryland appellate court. The concern here is that people who are involved in these lending platforms, whether it's marketplace lending or other types of traditional bank origination model, may find themselves being tagged as a broker, which may require them to be licensed in a variety of states, either as a credit services business or as a traditional loan broker. So that's something that certainly raises issues for them. Let me just, a couple of points, and I'll turn it over to Stu for some color on it. But there's really no, magic bullet that's going to eliminate these true creditor or Madden concerns that have been raised. It's going to take a while for these to work itself through the courts. I would imagine that other circuits over the next year are going to begin to hear similar cases to this. And really at the point where there's truly a split amongst the circuits, I think that's when maybe the Supreme Court will get involved. But I think we're looking at a degree of uncertainty just from a case law perspective going forward. Stu?
Okay, thanks, Jeff. So Jeff just talked a little bit about the law, and now I'm going to talk just a little bit about what's actually happening in deals. So the industry reactions have really been all across the map. Where we stand right now is that even despite all these cases, there is not a single loan that is clearly unenforceable or unlawful right now. I won't answer that right now. Figure out how to get that to stop, though.
I can do it.
Oops. All right, whatever.
Must
Sorry
be the
about
court
that.
calling.
Oh, sure. But the industry reactions have really been all across the map. So there are lots of folks that, because no loan is at this point unlawful or illegal, and most lawyers, I think, believe these cases have been wrongly decided, particularly the Madden and Think Finance cases have been wrongly decided. There are many deals where people are doing absolutely nothing and continuing to buy loans just the way they were before Madden and certainly before Think Finance. On the other hand, it's creeping up. There are other folks who are doing other things. So, for example, I think that there has been a run on 50 state surveys of what the usury caps are, and there are lots of folks who are trying to limit their exposure in any one state. There are definitely folks who are concerned that these are now the precedents that are out there and that they could be followed, and that the Supreme Court might not, whenever the Supreme Court rules, that they might not rule the right way, even though we all think and expect that they will rule the right way. One of the things, and if you hear me talk about this, some people think I sort of go on, I won't go on too long today, but about participations. And I've really been advocating using participations, and I think there's been a much greater interest in participations. No one would say that there's no arguments on the other side, but if Crispin is right, that when you have a credit card account and the bank continues to hold the account even though the entire receivable has been transferred, how could it not be a better and safer structure to have the bank hold the loan for the entire life of the loan? It has to be a better structure. Whether or not some court will say that still has a usury problem like Madden, whether or not a court might somehow say that 100% participation might still be a sham, it's got to be a better structure than buying the entire loan. So just quickly, again, you've got the bank holding the loan for the entire time. From the bank's standpoint, the bank gets an off-balance sheet transaction. It's a 100% participation without recourse. So under the accounting rules, it's off-balance sheet. They don't have to hold any capital. You can securitize that participation. Even if the bank were to become insolvent, you've got an FDIC safe harbor for participations without recourse. There's lots of good reasons. So why isn't everybody doing this right now? And the answer is, for all of the originators that are established, they really have to change everything. If you've got purchase agreements with lots of funds, you'd have to change the way you're doing things. You'd have to renegotiate those things. If you're a fund that's been a purchaser, it's a more complicated structure. We haven't seen participations being securitized. We need to educate rating agencies. We need to educate investors. So I think that we'll be seeing more participations as time goes on, but that's the reason I think we haven't seen them as much lately. And I guess we'll now turn it to Angela. You're going to talk about Reg AB.
I am. Thank you, Stuart. So I could probably talk about Reg AB2 for the next hour, but we don't have another hour because I will cut into drinks, and we certainly don't want to do that. So instead, what I'll try to do is make it through these slides, giving a 5-minute overview with just some of the high points. So we'll see how effectively John can keep up with where I am. So the first, Reg AB2 is effective. So all public ABS offerings after November 23rd, 2015 had to comply. So for anybody following the market, what a lot of people saw was people rushing into the market to get in before the deadline, and then now people coming back out as their shelves start becoming effective. And there are a lot of issuers with public programs that still do not have effective registration statements. So we're going to see a lot of that struggling to time deals and trying to get their shelves effective. For those who are already effective, they've got a little bit of an advantage over the rest of the market. The one thing that is not effective yet, however, is asset level disclosures for specified asset classes, including mortgages, auto loans, auto lease, and debt securities. That effective date is November 23rd this year. So now that people have made the first hurdle for Reg AB2 implementation, the issuers are turning to asset level data and really trying to figure out how this is going to work. So again, I'm just going to hit some of the, at this point, people probably understand what the new SF3 shelf registration statement requirements are. So I'm going to touch on a couple just implementation issues that we've been seeing. Some of these have been much easier than expected. Some have been surprisingly challenging from an implementation standpoint. The first is the depositor CEO certification. Although there was a lot of hand-wringing over that, I think where things have really come out is that companies have gotten comfortable that somebody's going to stand up, take responsibility for the securitizations. And what I've seen is a lot of sponsors putting in more robust processes. So this is great for the investment community. Companies were always taking their deals seriously, but now that you have an individual who's personally certifying, I'm seeing a lot more internal procedures, sub-certifications, discussions, a lot more thought going into this process before deals launch. So I think that's a good thing. The asset representations reviewer. Now recall that this doesn't even become effective really. You have to have an asset rep review agreement signed up when you do your deal, but the review doesn't become effective until you hit a delinquency trigger. So there hasn't been as much focus on what that delinquency trigger really is yet. I think it's too early to see where the market's going to go. I've seen a lot of triggers that are many multiples of the highest historical. Some people are doing step triggers over time. Some people are doing spot triggers. It'll be interesting to see whether there's enough investor feedback on those triggers to see whether or not the market starts pulling together to some kind of common norm. But instead with the asset rep review, where I've seen a lot of time and attention, has been making the representations in a deal more testable. If you ever hit the trigger, the asset rep reviewer has to come in and using some kind of testing procedures determine whether or not those reps were accurate with respect to a particular eligibility rep for a receivable. So a lot of these, like the compliance with law, how if you come in and you're just running audit type testing procedures, do you determine if something complies with law? So there's a lot of discussion going in about how to test these, and then conversely looking at some representations, deciding that they're not easily testable, and actually revising what those representations are. So I would expect to see more of that in deals, companies changing what that package of reps look like. And there's a little bit of tension there because most sponsors I've talked to aren't trying to they're not trying to change the coverage, but they are changing what the reps are. So around the margins, there's going to be some movement. This, of course, is a lot more challenging if you have a master trust where those eligibility reps might date back 15 years ago and trying to decide how to make those testing procedures for those reps. You don't have the same flexibility to revise what those representations might be. The dispute resolution provisions. This is a sleeper issue that people didn't expect to be a big implementation challenge, and it's ended up causing a lot of time and effort for those sponsors trying to make it through the registration process and through their first deals. So, just a reminder with the dispute resolution provision, this is a transaction documents must require that if a repurchase request has not been resolved within 180 days, then the requesting party has the right to refer the matter to mediation or third-party arbitration. So, it seems pretty straightforward. Ends up not being so straightforward. This is a place where the trustees are providing a lot of comments. As you might imagine, after their experience over the past couple of years, trustees don't want to be in the middle of litigation. There's questions about what does it take to make a repurchase demand? How much specificity must you have to trigger this provision that starts at 180 clock? And then one thing that market participants have found is that the SEC's views on this are, let's say, evolving. So there was a Reg AB2 implementation pilot project. So there were some people who filed registration statements early. Others in the market turned to look at those. And then what we're finding is that the SEC, even though there might be an existing registration statement that's effective with a particular provision, might now look and say, well, we want this. You can point and say, but this deal that's already effective has something different. So, well, this is our view. And there's always a little bit of a back and forth. A lot of, again, we'll say evolving to be kind to it. But so we're seeing that there's not the ability to go back to an existing registration statement, have provisions that you feel, okay, this works. And so there's a lot of back and forth on that process. And then the fourth new SF3 criteria is the investor communications. So far that has not caused any real implementation issues. A couple other things with the Reg AB2 that weren't as much of a focus as the Form SF3 requirements. And this is one that, if you look at all the investor reports for November and earlier and investor reports after December, and you're reading closely, you might see that the post-November 23rd investor reports have additional information on it. That's one of the new requirements that came in with Reg AB2 is there are new forms 10D and 10K and new line item requirements and some slight modifications to some existing requirements. So a lot of sponsors started looking at these requirements and realized that even for legacy deals, pre-Reg 82 deals, a lot of discussion about what kind of enhanced reporting they need to make. And so December started showing a lot of those new reports. One other major change, of course, is the speed bumps, and on page 34. So people are familiar with the, at least 3 business days prior to the first sale, you have to have your preliminary prospectus on file with the SEC. If you make a material change, you need to restart the clock and wait 48 hours. So one topic that's been subject to a lot of discussion in the industry is upsizing. How can you upsize a public deal with us? For some transactions, upsizing was traditionally done by just having your book out, and then you just have a different bond size. There was no additional paper coming around. That was fairly common with master trusts. For a certain asset class, though, in particular autos, upsizing was done by getting a feel of how investors feel about the transaction, getting a sense of investor demand, and then coming out with an upsize supplement, waiting a couple hours, and then pricing the deal. Well, with these new timelines for filings and delivery, if you make a material change and you have to wait 48 hours, traditional upsizing won't work. So right now, there seems to be a range where some people are taking the position that to upsize your transaction, that is not a material change. There's no 48-hour waiting period triggered, perhaps no additional supplement to that. Others are saying, no, we think based on past practice and maybe what our deal looks like, we think that might restart the clock. So we think that's going to be a problem. One possible solution to this for deals where people think it is a material change to upsize. 2 weeks ago, a deal came out, an auto deal, that had in the red 2 separate pools with 2 separate bond sizes. And so investors got the red. It said either you're going to buy into the, deal A with deal A or pool A backing it, or deal B with pool B backing it. And that is viewed as one way to solve that problem. And then I think where we're going to see a lot of discussion and activity this year again is on the implementation for asset level data and trying to figure out what that really is going to look like. For the Edgar system, there's some technical problems with just the size of fields, filing issues. Sponsor systems still need to be reprogrammed in some cases to catch up with these new requirements. And I think there's still an open issue about what will investors do with the data. And are you going to be obligated to use the data if it's available?
Okay, thank you, Angela. Carol, on to you for a brief overview of regulatory capital expectations for this year.
Great, thanks a lot, John. Fortunately or unfortunately, we don't have any new activity from the U.S. regulators over the last year with respect to risk-based capital. So we've got a lot of activity, though, at the Basel Committee, and that means that, as some of that activity becomes more final, we should expect some activity from the U.S. regulators and the regulators throughout the globe to implement at least some or all of the Basel Committee's recommendations. One that I think is on everybody's minds lately, actually 2 really, but I'll start with high quality securitizations and all of its iterations. This has been a very hot topic. We've got the Vegas conference coming up in a couple weeks. I think 2 panels devoted to this topic alone. I'll be moderating one of them. There are lots of proposals here, lots of iterations from different regulators, and most importantly, typical for structured finance, lots of acronyms. We have HQS for high quality securitizations. We have SSTs for simple, standard, transparent securitizations. That's the European Banking Authority. But they came up with another one, QS, for qualifying securitizations too, just for good measure. We've got STS, or for the European Commission's simple, transparent, and standardized securitizations. And the one that I'll talk about mostly today, though, will be the Basel Committee's STCs, not to be outdone. The simple, transparent, and comparable securitizations. That's the BCBS IOSCO version. And the one that SFIG, GFMA, and other industry advocates just submitted a comment letter on last week. SFIG, GFMA, just to have some more acronyms in there for all of us. So I'll focus on the STCs, and I'll start out by saying, and I think that this is a pretty safe prediction, the U.S. regulators have no intention of giving any regulatory capital benefit or making any changes to the U.S. regulatory capital rules to give effect to any of these acronyms. So even if transactions comply with the STCs, we'll talk about how that's a difficult thing to do. It's not likely that we'll see U.S. regulators adopting that, at least not anytime soon with the current regulators out there. So why do we have this whole concept and alphabet soup of all of these different high quality securitizations? Well, the objective, as you can imagine, it's really been largely driven outside the United States, and it's really designed to try to reinvigorate the investor appetite and comfort with ABS generally. And I think, as everybody in this room knows, that hasn't really been a huge issue in the United States. However, it has been and continues to be a huge issue in Europe, Asia, Australia, and that's really what's the driving force here. So they're looking to develop, a sort of a stamp of approval, so to speak, for particular ABS products that will develop a sustainable market and increase market liquidity generally. The benefit for banks is, and the reason that I'm talking about it as part of this discussion, is that some of the proposals, and the STC proposal is certainly one of them, will reduce in a reduction of what people perceive to be the surcharge in capital requirements that securitizations enjoy, in quotes, relative to other investments that are backed by the same assets. The STC capital impact in particular has the effect of reducing the floor for securitization exposures below 15%, which is the December 2014 framework's floor. As we all know, the U.S. floor is currently at 20. It will also reduce the P factor that's used in the IRBA, or the internal risk-based assessment approach. It will also reduce some of the risk weights in the ERBA, which is not usable in the U.S., but for the external ratings-based approach that will continue to be available to those outside the United States. Some considerations I've already hinted at, but one, certainly we've got level playing field issues here galore. If the U.S. doesn't adopt any of these proposals or give any sort of relief for securitization exposure capital charges, there's certainly going to be harmonization issues. And after what we've seen with Volcker and its various iterations around the globe, I am more and more skeptical about regulators having any desire to harmonize things like this, quite frankly, going forward for the securitization markets. Secondly, you've got the issue, as I mentioned, it's a stamp of approval. If you meet the criteria for an STC, well, that's a gold star, but what if you don't? Does that mean that you now have a scarlet letter? That sort of cliff effect and the corresponding deterioration potential in the liquidity for asset classes that don't meet the criteria of high quality securitizations is an issue. How to monitor it, how do you determine whether or not it meets the standard, who's going to do that, the issuer, the investor, some third party. And then of course all of the proposals are just riddled with specific problems that really make it difficult to envision that the ABS that we all work with and know and love will actually fit into any of these criteria. ABCP, for example, just isn't addressed at all. The criteria all seems to be heavily weighted towards asset classes that are shorter term, more highly granular, credit cards, for example, and the like, and also those that are issued in the public markets as opposed to private or 482 transactions that don't have disclosure documents. Another issue that people are talking about quite a bit lately is the FRTB, or the Fundamental Review of the Trading Book. This is to replace the trading book credit requirements that were adopted in Basel II. This, unlike the quality securitizations, is in final form, but it's at the Basel level. So at the Basel level, it's required to become effective in January 2019. Of course, everybody knows that something being final at the Basel level doesn't mean it's final. It actually has to be adopted by and implemented with implementing regulations by the relevant local regulators, and we haven't seen anything there in the United States yet. The key features of the FRTB is that it provides for more strict criteria to distinguish between trading book assets and banking book assets, and also to regulate transfers between the two, providing for some punitive impact for unwarranted transfers. It's revised the standardized approach to be more risk sensitive, which is a common theme in the more recent Basel proposals to reduce cliff effects. It's also note that the standardized approach is very important for securitizations, because securitizations in the FRTB, unlike with the banking book rules, securitization exposures cannot avail themselves at all of any of the internal models. And as most people know, the internal models are intended to have lower risk weights results if you have the necessary inputs to calculate them. So you're starting off with higher risk weights generally for securitization exposures just by making them use the standardized approach. The end result is that we have ultimate risk weights for securitization exposures under the FRTB that are 2 to 5 times higher generally for senior ABS positions than what exists in the current SSFA framework that we have under the US rules that were final in June of 2013. And it's even worse than that for longer tenor ABS, like really CMBS and non-agency RMBS. This is obviously a concern for the industry and the secondary market liquidity in particular. There's one last change that I'll just mention is out there. It's really in just preliminary form, but there's a proposal by Basel out there to make changes to the standardized approach generally. As everybody knows, Basel came out with a proposed changes to the securitization framework in final form in December of 2014. That's just for the securitization framework. This revision proposal is with respect to the other aspects of the standardized approach, so it would pick up changes to the wholesale and retail exposures. You can guess that they're not lowering the risk weights for those exposures as a general matter. So with that, I think that's probably enough for risk-based capital today.
Okay, thank you, Carol. And I'm going to blaze through mortgage here quickly and hopefully encourage my fellow panelists to do a little bit of the same so we can get ourselves back on track here. The mortgage market continues to remain pretty fractionalized in the U.S. There's not much to expect this year, which is why I'm going to move through this quickly. I think the government will continue to dominate the mortgage market. They're involved in almost 90% of mortgage activity right now. I don't see that changing until we have another election, and depending on how that comes out, that might continue to be the case. One interesting development that was noteworthy at the end of last year in the mortgage market was the integration of the Truth in Lending Act and Real Estate Settlement Procedures Act disclosure, that if you ever had a mortgage loan, you get flooded with paperwork before you take out the mortgage loan. The CFPB is trying to consolidate some of that and simplify it. The issue has been implementation. It's hard for mortgage originators to change their systems. There's been some errors. And at the end of last year, the CFPB wrote a letter saying that if there's some errors in implementation, it shouldn't affect the secondary market for your loans, because if this disclosure isn't right, secondary market buyers, which would be people in the securitization markets, could impact the enforceability of the loans. And that was something that the CFPB wanted to point out. At least for now, they were not looking to be punitive. Maybe a first for the CFPB in terms of saying that. The qualified mortgage market, just as a reminder, is loans that meet safe harbor requirements, such that if the borrower's ability to repay is established under these safe harbors, there's not secondary market assignee liability in terms of defenses to enforcement by borrowers against secondary market holders. So it's a pretty important change to the old rules. And that came into effect prior to this year, so that's not anything new. But it is something that's kind of sand in the gears of the development of or redevelopment of a healthy credit tiered mortgage market. I think people are very hesitant to make loans that don't meet the qualified mortgage standard, which include criteria regarding income, for example, debt to income ratios that would disqualify a lot of the subprime market. And so the subprime market has really continued to be very, very quiet. There's a lot of activity there with Ginnie Mae, but not outside of the government. I think we'll continue to see that unless the CFPB comes out and clarifies that you can satisfy ability to repay other than through the safe harbors, which I'm not expecting them to do. And they've pretty much said that to people, that they're waiting for the market to develop around the existing rules. There's still, again, a healthy securitization market for mortgage products that aren't government products, but it's more fractionalized. So some of the things we'll see this year are continued non-performing loan and re-performing loan securitizations, single-family rental securitizations, reverse mortgages are becoming more popular with the baby boom population reaching retirement age. Servicing advances, so the advances mortgage servicers make to support regular payments in their securitizations that they service, those advances are going to continue to be securitized. And then we see activity from other parts of the world where mortgage loans in places like Australia are getting funded with U.S. securitization debt. We'll continue to see that. We're also going to continue to see some development around servicing rights financings. Servicing rights are an interesting asset. It's really the servicer's right to get paid over time for servicing a pool of mortgage loans. It has intrinsic value because it's a present value stream of payments, which of course gets people interested in securitization and financing. There is an increasing market for that, particularly with the government sponsored servicing, Fannie Mae, Freddie Mac, Ginnie Mae, where they're willing to acknowledge the existence of lenders and their rights in the underlying mortgage servicing. It's beyond the scope of this presentation today, but I think we'll continue to see evolution there as mortgage servicers get continually pressed for capital to grow their businesses and are looking for financing. So with that, I'm going to turn it over to you, Stu, for 3 minutes on margin rules for uncleared swaps.
Okay, I've got 3 minutes. All right, so we're not going to get into a lot of detail. So when clearing rules for swaps came into effect, clearing required margin. So we all spent lots and lots of time coming up with creative ways to come up with swaps that wouldn't need to be cleared, so we wouldn't have to have margin. And now we have new rules that will require margin for all of those swaps that don't have to be cleared. This is not as much of a term ABS issue unless you're talking about cross-border transactions with currency swaps. This is really much more of a conduit financing kind of an issue, bank-funded deal kind of an issue. The rules become effective initially, compliance is required September 1st of this year, but only for really the biggest parties that have the biggest size of their covered swap portfolios. And then the requirements come into effect for smaller parties over the rest of this decade. The way the rules work are there is an initial margin requirement for some folks if they have a large enough portfolio, $8 billion of average daily notional amounts of covered swaps. That's not going to happen to a lot of folks, but what will happen is variation margin. So what that means is that the parties have to calculate, post, and collect collateral on a daily basis, and it's measured on a mark-to-market basis every day on the value of the covered swap. So one of the important issues is going to be, how do you even make this work in transactions that typically have monthly reporting and a monthly settlement date? And how does it work in a way that would be consistent with bankruptcy remoteness to be able to get margin into a bankruptcy remote SPE? Important exemption, captive finance companies are exempt. And I think with that, I'll let you go on to the next topic.
Okay, the next topic is bail-in rules, which came into effect very, very recently. So Jeff, I'll turn it over for you to start our discussion on that.
Okay. The EU Bank Recovery and Resolution Directive was issued in response to the financial crisis. Thank you, Brad. The directive basically requires that banks and other participants in the EU write down or convert to equity or cancel certain unsecured liabilities. if necessary, to recapitalize the bank. So it's bail-in as opposed to taxpayer bailout, I guess is how they've come up with this. It was effective, as John indicated, January 1st of this year, and it's having an impact in the U.S. market, obviously. It doesn't apply to U.S. banks or the foreign branches of U.S. banks, but it does apply to the U.S. branches of foreign banks. So the EU banks and their U.S. branches are covered by it. Although it's self-effectuating in the EU, for contracts that are signed outside the EU for loan agreements and the like, there needs to be a contractual recognition provision included within the contract. That way it can be enforced and the parties agree to it. So there's been a lot of work with the LTSA and others putting together these clauses to be adopted and included in the agreements. Just the one point I'll make before I turn it over to Carol is, whilst typical debt obligations, by a EU bank as issuer or as borrower are clearly covered, the coverage goes well beyond that. I mean, it applies to basically any liability that's not excluded. So secured liabilities are excluded and covered bonds are excluded, but it's much broader than that. I even included on the slide just an example of some of the things that are highlighted because, when I first saw this, I was thinking to myself, this doesn't necessarily seem intuitive to me, but because of the breadth of the scope of it, I think it's having some ramifications in the U.S., and I'll let Carol talk about that.
Okay, great. As Jeff indicated, intuitively you look at it and it really shouldn't give rise to a huge amount of issues because, typically in transactions and ABS transactions where the bank is a lender or the investor, folks aren't really concerned about their insolvency. But where we're seeing issues as a practical matter is just ensuring that the contractual bail-in provisions that are required by the rule are included in documentation. And for transactions where we have U.S. banks that are entering into transactions either as agent or bilaterally, just considering whether or not it needs to be added so that you can easily syndicate the transaction to an EU bank after the fact. We've also run across a bunch of issues with respect to opinions. As you can imagine, the bail-in rule and the contractual provision isn't the sort of thing that's normally covered by legal opinions right now. But there is some concern that the requirement itself requires EU banks to be able to demonstrate or to be able to obtain an opinion at the request of their regulator. That's something that at this point still hasn't quite frankly come to rest. I think probably the norm at this point is that law firms are generally excluding Dodd-Frank type provisions and these EU regulatory type provisions generally which would pick this up.
Okay, well, now we're going to talk about upcoming rules, and believe it or not, there still are more rules to come. Limited, but more rules to come. And Stu, if you could cover what's on the horizon this year or beyond in terms of new rules.
Okay, so as you could tell just by the isolated stuff that I've been talking about, I kind of took all the topics nobody else wanted to talk about. And so the next one is the Basel step-in risk proposal. So this is a proposal that's out right now, a very recent proposal. Comments are due March 17th. And the basic idea of this proposal is that the regulators potentially would want to either require regulatory consolidation or come up with another way for banks to hold additional capital against deals that they feel there's a greater chance the bank might step in. That's why they call it step-in risk. Step in and save. So whether it's moral recourse or the risk of reputational harm or risk to the franchise if they don't step in, additional capital because you might support an unconsolidated transaction, some other entity that's not on your balance sheet. And so right now, and what are some of the indicators in the proposal of when you might have that risk? Well, in all sorts of them, they're very wide. Just a few of them are sponsorship, providing financing to an entity, providing critical services to an entity, being a decision maker, operational ties, implicit recourse, rights to excess cash flows, branding. If your name's on the door, maybe you're more likely to save that entity. So, of course, the comment letters are being drafted right now. Some of the expected industry comments are, one, the accounting rules have changed. Now that the accounting rules have changed, the stuff that the regulators are worrying about, probably they don't need to worry about as much. They're focused on unconsolidated entities. And a lot of the entities that you would typically have this kind of that you'd think you'd have this kind of a risk, probably are already on balance sheet now. And if they're not, then probably that's a weakness in the accounting rules. We don't need special capital rules to make that happen. Also, the indicators of risk are way too expansive. Just merely providing financing, that's what banks do. The idea that merely providing financing to an entity could be an indicator that you need to hold extra capital. It could require banks to potentially hold capital against every off-balance sheet entity they do business with. And then some of the indicators probably don't necessarily, in fact, indicate any real step in risk. I'll move on to conflicts, John, if you want to go to the next slide. John?
We're there.
Oh, you're there. Good. All right, we're not going to spend any real time on this. This is a proposal that was out there that's been out there for a long time. Comment letters have been done for now years, but it is still out there. So Dodd-Frank Section 621 would prohibit material conflicts of interest with ABS investors for up to a year after closing. It would apply to both public and private transactions. The SEC's actual rule tracked the statute and was really, really broad. There are all sorts of different conflicts. Every issue that you can imagine between an issuer and an investor, for example, is potentially a conflict subject to these rules. But the release actually made clear that the SEC was thinking about something much more narrow. Transactions like the Abacus transaction, where somebody was shorting a bond that they actually had something to do with issuing or underwriting. And final rules could be adopted potentially at any time, because again, the comment letters are all in. And if the rule comes out the way it was proposed, we have no idea how much uncertainty could be created by these rules.
Okay, we're going to cover predictions quickly, and then that'll give us a little bit of time for questions. And this is my favorite part of this presentation because it's always interesting to see what people say. I'll start, and I'll just say that 5 years ago, I didn't know whether I would need to return to my focus in law school, which was estate planning, or whether I'd still be here today, and I'm standing here today. And we've got a room full of people who are in some way involved in structured finance. And what I like to say is that what doesn't kill you makes you stronger. And I know that people who deal with regulatory issues on a daily basis don't necessarily believe that. But I talk to investors who buy securitization paper and who are involved in the market on that side. And they do believe that it's safer to securitize now. They do believe that all of the regulations around disclosure provide greater transparency. They like that. They do believe that some of the economic interests that are now in play, the credit risk retention rules in the U.S. and Europe, the bank regulatory changes, which are PhD level in terms of complication, but the intended effect is to make sure that banks have more of a cushion to withstand losses and volatility. And to some degree, that's probably a good thing. And so I'm not ready to feel the burn yet and destroy all the big banks and go back to a community bank model. But I do think that some of this has been good, and I think that it actually has made the market more robust. So that's my prediction, that the market will continue to be robust and continue to be having staying power, and will continue to survive now and for years to come. Julie, over to you. You're going to pass? Okay.
I viewed a lot of your predictions as a comment, John, actually, on the market, but two comments that I would have. People who have heard me speak will know that I normally don't say that I think that the increased regulation is a good thing for banks, and I continue to think that it's going to be a bit over-regulated, and it makes it very difficult for me to imagine how banks are going to be able to work at a profit, quite frankly, given the levels of compliance necessary to deal with all of the regulation and the increased cost in doing so. But somehow they managed to muddle through and just reduce expenses like legal fees. One thing that I find a troubling theme throughout these regulations as well is the apparent lack of respect that regulators have for the legal separateness of entities. And I don't see that really dissipating. That's really implicit in a bunch of the new rules that we have. It's really implicit in Volcker. The idea that the harms of one banking entity are going to infect all of its affiliates and other sponsored entities. The step-in risk rules that the proposal that Stu just talked about, the 2A7 sponsorship association has assumed that the entity is going to step in and save the fund there, and so it must be counted as the issuer itself, and the affiliation rules there as well. I don't see that really changing, unfortunately. The U.S. regulators continuing to be more prescriptive in the way that they draft legislation, I don't see changing. So many of the reasons that we run into problematic opinion issues with transactions lately is because when you look at the newer regulations like Volcker and risk retention, when something's drafted to be a safe harbor or another exclusion from a rule, it's done in a way that's so 100%, and any deviation is a complete fail. So there's that cliff effect that I referred to in the Basel rules as well. That wasn't the case, 10, 20 years ago prior to the credit crisis and rules. We had, you look at 3A7, for example, in the Investment Company Act, and it required primarily engaged for 3C5, it's primarily engaged, or 3A7, the assets have to be primarily all of this particular type. But in the safe harbors in our new rules, it's 100% compliance with every single I dotted and T crossed, and it makes it very difficult to get comfortable that you're complying all of the time, and I think that's unfortunate. It's increasing the compliance burden, and I don't see that stopping.
Okay, Stu, comments or predictions?
Carol, you were so negative, and I am so much more optimistic than you.
I thought that was positive.
And honestly, I felt after hearing you how much I really needed the drink that's in the hallway. But honestly, I think that I think that banks definitely have issues, and the bank regulatory environment for securitization isn't as helpful as it could be. But fortunately, I actually look at the world through a lawyer's eyes, and through a lawyer's eyes, actually, the future looks. I don't want to sound bad, but the future looks actually quite bright. So first of all, let's start with this year. I still believe, I don't believe it as strongly as I did on a phone call John and I did at the very beginning of the year, but I still believe that the fourth quarter of this year will be the busiest quarter the asset-backed market has ever seen. Now, why is that? It's because the risk retention rules come in on Christmas Eve for everything that's not RMBS, and we also have asset level data that's coming in beginning around Thanksgiving. And so I think that everybody who would be an issuer after those dates is probably going to accelerate their deals. And so I think we're going to have a very busy year this year, and particularly the fourth quarter will be extremely busy. And so that's number one. Number two, even for banks, I think that banks will have much more incentives to be issuers in the future than they do now. Banks are all subject to what I call the frightful five, and everybody's been telling me to find a new expression for that. I think it's a very good expression. I think of the frightful five as being capital, leverage, liquidity coverage ratio, future net stable funding ratio, and CCAR, the stress tests. And so when you look at capital requirements and leverage ratios, banks are going to want to have more reasons to get off balance sheet. When you look at the liquidity coverage ratio and the net stable funding ratio, banks are going to want to have more reasons to not fund assets through deposits and other short-term liabilities and securitization is a very good way of doing that. And in particular for low margin, low ROA type assets, I think we're going to see banks doing more securitization. You're already seeing it with the prime auto loans that banks have. They're already doing securitization and doing residual sales to get off balance sheet. I'm probably taking up more than my time. I have a lot of other predictions, but I'll let somebody else talk.
Well, and you can share them privately with people over your cocktails. So. Jeff, anything from you?
I'll just make one prediction. I predict that securitization lawyers will have an increasing interest in the bank origination model and the cases that arise challenging it over the coming year.
All right, are you going to go out on a limb like Jeff, Angela?
Well, I'm going to try to, after Carol's kind of downer moment, I'm going to try to bring it back up and continue that direction. Although she did really prime the mood for the cocktails we have out there. People have been using a lot of analogies to talk about the past year, and what people keep on telling me about is it feels like we're drowning with all these waves of regulations. But that's kind of pessimistic. And instead I prefer more of the, we're hiking up the mountain. And there's people who look at the mountain and they say, gosh, that's a really big mountain, I'm not even going to try to climb it. And there's other people who make it to one peak and they say, okay, I made this one, oh my gosh, there's another peak, I give up, I'm out. But there's a group that keeps on going. And at the end of that, I think for anybody who's made it up to the top of that mountain of all these regulations, and the market's going to be much stronger, those companies are going to be much stronger, there's going to be a lot more transparency, a lot more faith in the deals people are doing. And what I've seen is, and it's part of that climbing the mountain, a lot of cooperation in the industry, because I think what I've seen is more and more people realizing that it's to all of our advantages. Getting on a call with a bunch of issuers who are competitors in one way, but they're all really hoping that somebody else can succeed. And I think that's terrific to see this industry working together to make it through these challenges, so we're not drowning, but we're kind of climbing out of this and getting stronger.
Okay, well, we are at the end of our prepared remarks. Is there anybody who's got a question that you want to raise before we dismiss class for the evening? Anybody with anything that they want to raise? Okay. Well, thank you very much for coming. Anybody here is happy to go deeper into these topics that they've brought up today. You have our email addresses and our phone numbers. We love questions, and so please don't hesitate to do that. Thanks again for attending.